Hello, welcome to the Vertical Spread Options Trading YouTube channel. My name is Eric, and in this video, we're going to take a look at a 15+ year price action study I've put together for you guys on the IWM, which is the Russell 2000 ETF. And really the focus of the study is to give us some probabilities when it comes to selling put credit spreads or bull put spreads on the IWM. And this is very easily translatable over to the RUT. So if you're used to trading the index, I actually prefer the index myself, but all of this will apply to trading the RUT as well, and you'll see what I'm talking about in a minute. So before we get started, we're going to go through this PowerPoint. If you'd like a PDF copy of the PowerPoint to take with you after the video, I'm going to put a link in the description of this video on how to get that, and also in the description there'll be some information on how to get emailed trade alerts similar to what we're discussing here in a minute. I do a lot of RUT and SPX a few times a month, so if you're interested in getting some trade alerts, check that out as well. All right, so let's get into the PowerPoint. And before we dive into the study, I want to talk about a couple things that you really just kind of need to understand before you trade any kind of options. So there's three main things that as an option seller you really kind of want to be concerned with. Liquidity is the first thing. So whatever ticker you're going to trade, and we're talking about IWM, which is very liquid, so it's not really a factor here, but it really needs to be kind of heavily traded so that you can minimize slippage and you can get in and out of the trades faster. So we're talking about IWM and the RUT's relatively liquid as well. The other thing is volatility and really kind of understanding what the current volatility levels mean for the option strategy you use. That's going to apply a little bit to what we're going to talk about with this study. But for me, one of the best things to really focus on is probability. And that's also what the focus of this study is. And it's really choosing the proper strategies and the strikes and the days to expiration, all that stuff. And that way you can kind of make consistent gains over time. If you trade the math and you trade the probabilities, you understand that you're going to have a better chance of success over time, so you can stay in this game for a while. So kind of just wanted to open with that. And again, we're going to mainly discuss probability here and volatility a little bit. We've already kind of covered liquidity because we're going to be trading the IWM. Okay, so real quick, so the information that we're going to go over here, it's not a complete trading plan. We're not going to talk about position size and that kind of stuff or adjustments. We're really just looking at the probabilities, and we're going to look at the probabilities from the past 15 years or so, a little over 15 years of this is actual historical data from the Russell 2000, the IWM. And we're going to focus on price action and price levels that you should maybe consider if you're looking to sell put credit spreads on the IWM or the RUT. And there's two. From the price action perspective, we're going to be looking at sell-offs, and price levels, we're going to be looking at percentage of those sell-offs. So let's go ahead and just kind of talk about, before we look at all the information, I want you to really understand what the study is covering. So what we're going to be looking at from the price action perspective is a 2-day decline. That is the price action. And on this, I kind of clipped a random section of the IWM. This is from this, I think, earlier this year. But anyway, you can see all these little yellow arrows. Those are the second day of a sell-off, a 2-day sell-off. So you have, you have a red candle. Second day, that would be a part of the study. That's when the study would start, and we'll talk more about that in a minute. So you have a 2-day study here. This is interesting. So I want to show, like, if you have a 3-day sell-off, as we do in this section, then it's actually two-day sell-offs, right? Because this is actually a 2-day sell-off too. So some of the 2-day sell-offs are actually part of a 3 or 4-day sell-off, and here we just have that one. But basically, after a 2-day decline or a 2-day sell-off, what we want to look at is where is price 7, 14, 21, and 28 days later. So what I tried to do is, if we sold off for 2 days in a row, where is the price 7 days later? Is it higher? Is it lower? How much higher? How much lower? And I did different time frames because some people like to operate in different time frames. I typically would sell put credit spreads more like 30 days out, and then I might want to know where it is 14 days later so I can maybe collect half my credit and close, that kind of thing. But I'm going to give you all that information as part of the study here in a minute. So let's kind of establish some verbiage here. So each 2-day decline, we're going to call this a trigger point. And the trigger point means that's where the 2-day decline was and where we would consider selling a put credit spread. So again, not a complete trading plan, but we're just going to say if we sold a put credit spread here, that's where the 7, 14, 21, and 28 days later thing will come in. So when we talk about the trigger point, we're talking about the end of day close. Okay, so these are all end of day price closes of the IWM for the past 15 years. And then what we want to do, since we're going to be selling put credit spreads, typically you're going to want to sell something that's a little bit out of the money. So we not only want to see where it is, 7 days later or 14 days later, we want to know where it is if it's lower than that. So we're going to examine price levels that are 2, 3, and 4% lower than the trigger point. So let's kind of look at that real quick. So again, after a 2-day decline, where is price 7, 14, 21, 28 days later? So I chose this example. So here we had a 2-day sell-off on this yellow arrow. So the trigger point close here was 140.54. So what we're going to look at is, well, is it above 2% lower 7 days later? Is it above 3% lower? Is it above 4% lower? Because remember, we're going to sell out of the money put credit spreads, which means that if the price goes against you a little bit, that's actually okay. We don't need it to be above the actual close price. So we're going to kind of take that into consideration, and we're going to look at the results of these different levels. So again, we're going to look at the trigger point, which is the daily close, and then what the likelihood or probability of the past 15 years that it was above these other levels. So I know that's kind of a lot. Feel free to watch the video. This is why I wanted to kind of offer you the PDF. So make sure if you want to take this with you, that's great. Okay, so all right, so let's go ahead and look at the results of the 15-year study. So I tried to organize this and what kind of made sense for me. So the first section here is, they're all kind of similar, first of all. So they're all 2 days down, 7 days later, 14, 21, 28 days later. They're all the same duration, the months. This is actually interesting, and part of the reason I chose 2 days down is because it gives you a pretty good frequency. Over the past 15 years, there's been an average of 4 to 5 trades per month. Obviously, it's not equal. You're going to have some months with more. You might have a month that doesn't have any. But on average, this should give you 4 or 5 trigger points per month. And this was the time frame of the study. It's from mid-June 2000 all the way to December 30th, 2016. So it's just over 15 years. And this is the section that's really different for each section. So here we're looking at above the 2% trigger point. So let me go back to this chart. So this first section is saying, okay, on 2 days down, 7 days later, 14 days later, this is the results of where it is above the 2% level. So that means 2% below the trigger point. So let's go back to the chart here. So you can see that after a 2-day sell-off, 7 days later, almost 80% of the time, it's above that 2% level. So if you're selling short-term options, like weekly options, maybe you're selling 7 days out, 10 days out, there's actually a decent chance that it stays above your level. Now, that doesn't mean that it doesn't mean that it'll stay above. It just means that it ends up above. So it could actually blow through it, but it's almost an 80% chance that it is above that 2% level. So 14 days later, 2 weeks later, it's about a 71% chance. And you can see basically 2 weeks, 3 weeks, and 4 weeks later, there's still about a 70% chance that it ends up above those levels, above the 2% below the trigger point. Hopefully that makes sense. So the next thing we're going to look at is what's the likelihood that it's above the 3% trigger point, 3% below the trigger point, which means if it sells off, you could sell even farther out of the money, which should be higher probability. And let's look at those probabilities again. So we're going to look at the second section. All the information is just the same, but this time the probability that it's above 3% below the trigger point. So you can see the probabilities actually start to increase a little bit. So if you can if you can get a good credit that's 3% below that second day close, you have over an 80% chance that it's going to close above that after 7 days. What's interesting to me is, and we can go ahead and glance at the 4 days, is the 7 days later, is always a little bit higher, which I haven't really processed that, or I don't have an interpretation of that yet. My initial gut reaction is saying, yeah, you get some ridiculous sell-off, it's going to bounce back a little bit. So, but it's just interesting that, if you can sell a put credit spread that's 3% below the trigger point, that 7 days later, there's a pretty good chance it stays above your short strike, in which you should be able to collect some credit. So kind of interesting. And we'll just go ahead and look at the 4% below. So again, if this was the close and you can sell it, you get a good credit for a credit spread down here at 135. That's 4% away. There's almost 80% chance on most of these, and almost 87% chance that it's going to be above that 7 days later. The way that I kind of look at this is, since I trade a little bit farther out, 30, 45-day credit spreads, I like looking at the 21, 28 days later, because usually when you sell farther out in time, you're able to get farther away from the money, meaning you can do that 4% trade, and you're going to have a pretty good probability that 3-4 weeks later it's still above that, and by that point you should have collected some credit, or at least you're still kind of in the game on that. So hopefully that makes sense. Before we go, let's go ahead and take a look at the RUT right now, as of this video, and just kind of the current environment, and just to see how you could potentially apply this. So first of all, we don't have a 2-day sell-off, but let's just sort of pretend for a second that we had a 2-day sell-off yesterday, and these are what the levels would be to what we had just discussed. So again, the close was 1475 and a quarter. So 2% lower is about 1445 and a half. 3% lower is about 1430 and 3/4, and 4% lower is about 1416. So in the current environment, let's see what kind of credit we could get with the standard sort of monthly credit spread. We're not going to go through all this, but I just wanted to kind of get some practicality here. So if we go to the option chain, I'm going to look at the December options. They're about 32 days out. So again, the 4% below the 1416, we could look at the 1415, which is about a delta 20, which is actually pretty good. If you'll notice the other levels, they're 1430, 1445. They're about 15 points in between. So a 1415 is, a lot of people like to sell way down here in the, which is good. You can see I'm currently in one from a couple days ago. But if we looked at the 1430, that's a delta 25, and the 1445 is about a delta 32. So depending on the time frame, we're looking at 32 days. So I would probably look at something around the delta 20 in this case. So if we went to sell that delta 20, this is 32 days out, you can see that we could get about a 65-cent credit for that. It is a $5 strike spread. Now, one of the things we kind of skipped over a little bit is the volatility. What I like about this strategy is selling on that second day sell-off is typically you get a little spike in the volatility. So you can see we started a little sell-off here. As the volatility spikes, you're going to get a little bit better credit. And I think this is where I entered on this spike down. It's actually on this day. This spike down, and I entered my credit spread a few days ago. And then it kind of came back up. So I'm actually up in the trade because I took advantage of that. Now, it actually didn't close on that second day, but when it's selling off hard on that second day, I'm looking to make some kind of entry. And I personally like the delta 20 area, and that put me about 4% or so below. And then I can go back to sort of this study to say, okay, yeah, 4% below, there should be an 80% chance or so that it stays above there over the next couple weeks. And then I would look to either, if it rallied, I'd collect all my credit, or I could look to close for collecting half my credit. So that's kind of how I apply that. That's a really loose and sloppy kind of ending to this video. But again, I just wanted to give you some probabilities that you can kind of have in your back pocket if you're looking to trade the Russell. And we're looking at those 2-day sell-offs. So again, that's all I got. You guys have a great day, and we'll see you at the next video.